Okay, welcome everybody. There's a few people that are still working on joining the webinar, so we're going to give them a couple of minutes, let people kind of continue to join here, and then we're going to get started here very shortly. Okay, let's see. Let's go ahead and get started. So, welcome everybody to this webinar, this virtual webinar that we're doing on required minimum distributions. As many of you are already aware, this is part of a broader initiative called the Public Education Series, which is a program that we started years ago, and we'll chat about that a little bit later into the presentation. But I just wanted to say a quick welcome. My name is Sam McElroy, and
I'm Tab Cook.
And we're going to be your presenters for the webinar today. So let's go ahead and jump into the material here. And let's get started. So we want to start just with a little bit of a brain teaser. And so we have two numbers here on the screen, 639,000 and 40.4 billion. And the question that we would encourage you to ask yourself is, what in the world do these two numbers represent? And as many times as we've done this workshop, nobody has ever gotten the answer right, but it's probably a little closer to the topic than what you might be thinking. In fact, there was a article or research paper, I don't know what you want to call it, a finding maybe, that was put forth by the Treasury Department. And this was, I think it was back in 2015, that was analyzing the impact of RMD rules and penalties levied against it because people didn't understand what they needed to do and when they needed to do it. And inside of that finding, they looked at a subset of taxpayers, about $639,000 in that given, or sorry, 639,000 people in that tax year that had actually failed to take the required minimum distribution when they were supposed to and in the amount that they were supposed to. And what they found was that the collective retirement accounts for that 639,000 individuals totaled a little over $40 billion. So they actually went a step further and they looked at a smaller subset, and I know you can't read this on the screen right now, but this is just a snapshot of the actual paper that was published. And they looked at a smaller subset of about 6,500 taxpayers that actually specifically filed a form, in a sense, to self-identify that they missed their RMD. And they found that from that smaller subset, the excise tax was about $6.2 million. So we always start by, asking people if they know what the penalty is for not finishing or taking their RMD in the way they're supposed to, in the timely fashion that they're supposed to. And usually hands will kind of shoot up and people say, eventually somebody will say 50%. And we'll say, that's right, 50%, 50. In fact, it's one of the largest penalties of that type that the IRS actually levies. And it's one of the reasons why a really solid required minimum distribution or RMD strategy has to be incorporated into the overall retirement plan just in and of itself. And so in the webinar that we're going through right now, these are our learning objectives. We're going to talk about the impact of the coronavirus on your retirement. We're going to talk about how to protect yourself from potential downside in the future. We need to talk about how the new Secure Act, which was just passed in December of 2019, has actually changed not only what may happen in your retirement, but the retirement of other people in your family, and specifically what that means with respect to required minimum distributions. And then we're going to still go through some of the basics. How do you calculate RMDs? Should you look at Roth conversions? What are some tax strategies? How do you ensure that meeting the required minimum distribution doesn't unintentionally cause you to cannibalize your account? So those are some of the things that we're going to go through. And we're going to do that specifically by starting with the basics. What are RMDs? Where do they come from? How do you calculate them? What are the tax implications? Then we're going to move into talking about some of the biggest mistakes that we see people make when it comes to RMD planning, and hopefully how you can avoid them. We're going to talk about how to integrate an RMD strategy into your overall retirement plan. So, for example, how do you manage cash flow just in general in retirement? And after we get through that, we're going to try to talk about some risk factors, and then we're going to talk about the dangers of ignoring RMDs, and we're going to try to wrap this all together with a case study. So as we introduced ourselves a little bit earlier, my name is Sam McElroy, and this is Tad Cook. And we've been working with people around retirement income distribution for a number of years now. And in fact, it's one of the topics that we feel is so grossly misunderstood, and one of the reasons why we started doing these webinar series that we do right now. So a little bit about us, just so you know who's presenting to you. We own and operate an SEC registered investment advisory firm. If we're looking at the securities level, we manage probably about 120 million in assets. If we look across all levels, maybe a little bit closer to 180 to 200,000. And that's working predominantly with about 500 families throughout the Midwest. In addition to that, one of the core tenets that we founded the firm on was this vision for promoting financial literacy. And so we started the public education series years ago. As best as we can quantify, we've done a little over 150 workshops and had an opportunity to train over 2,000 individuals. And it's also the reason that we started our syndicated radio show called Mindful Monies, which airs Saturday mornings at 10 o'clock. So just a little bit about us. Now, I've mentioned this public education series, and I know that some of you that are participating in the webinar here have been to other parts or other things that we've taught through the public education series, or maybe even be current clients working with us. But for some of you that this is your first experience to one of these workshops, we wanted to start out just by saying welcome and just giving you a little bit of heads up of what to expect. You know, we always do these workshops in two parts. Right now, you're participating in what we would consider to be the group lecture. And the main goal here is to try to get you familiar with some terms and concepts and basic strategies. Following this, we always do a second part, which is really more of a one-on-one lab. And the idea is to help deliver some type of report, tangible report connected to the topic that we're talking about. So in this case, the one that we're going to be talking a lot about is something that we call an RMD risk report. In fact, this is probably one of the best tools we have ever used for our clients to be able to try to help them understand not only what they need to do for required minimum distributions, but to help them understand just how they're positioned, whether there's any potential problems and how they're positioned connected to the rules around RMDs. And so for all of you that are attending this webinar now, we're going to talk a little bit later about how you're going to get your copy of an RMD risk report. But we're going to refer back to it a couple of times as we go through the core content here that we're talking about. So topic number one, Tad's going to kick us off and start talking about some of the basics connected to required minimum distributions.
Yes, and we really like, why do RMDs exist in the first place? And we really like to point out up front that if you kind of start thinking to yourself, hey, why are we learning about all this stuff and why do RMDs exist in the first place? The current generation is really the first one that has been dealing with required minimum distributions. Our parents' generation, who retired, the World War II generation, retired in the 80s and 90s, didn't have the IRAs to worry about. Most of them had pensions instead. But the whole idea behind an RMD is that the government wants you to save for retirement, that at a certain point in your life, they want you to now start taking the money back out and paying the taxes on it. So they've waited long enough throughout your working careers. You've been deducting X amount of dollars every year and deducting it from your tax return. They want to make sure on a systematic basis that you are pulling money back out of your retirement accounts. And we'll go through this evening exactly how that works and how you figure out what you need to do. So when do you have to start taking RMDs? After age 70 and a half, if you're 70 and a half by December 31st, 2019. Otherwise, and for most of you listening, it will be at age 72. During the year that you turn 72. The last date allowed for the first withdrawal, the first time only, is actually April 1st of the following year. So if you're turning 72 this year, you actually have until April 1st of next year to pay the first required minimum distribution, pay the taxes on that money. However, if you do that, you'll owe two RMDs next year because you'll owe the one for 2020 and the one for 2021 as well. So most people don't do it that way. The exception is noted at the bottom here. If you're still working at age 72 and participating in the retirement plan at a business that you do not own, You don't have to take an RMD from that plan only. You will from other assets. How much will your RMDs be? Well, it's a formula, and we'll show you a little bit of it on the tables that follow in following slides. But you're going to take the balance, and let's pretend you just have one IRA to make this simple. The balance of your account on December 31st of the preceding year divided by your IRS assumed life expectancy. We'll show you the table that comes from. But the example we're showing you here in the middle of the slide is, let's say that you ended 2019 with $158,225 in your IRA. You divide that by the divisor that we'll show you in the table, and your RMD will be $6,406. We tell people that it is roughly 4% the first year. This is age 73, so it's going to be a little bit higher than that, but that's the ballpark of what they want you to take out. It's a little bit easier to figure it that way. So let's look at this IRS Uniform Lifetime Table. If you kind of want an idea of what this is kind of based on, if you live to age 70, they're thinking, well, on average, people will now live another 27 years to age 71 and so on. So it's a decreasing number. Rough idea is that, if you made it that far, how many more years could you potentially have on average? But so you take, if you're 77 years old, you take the IRA amount from the end of the prior year and divide it by 21.2, etc. What if you say my spouse is more than 10 years younger than I am? Well, now you have a different calculation, because the IRS wants to give the younger spouse a little bit more time to be using this money in the IRA, even though it's in the older person's account. So you would, in this case, use divided by 27.9. It's called a joint life and last survivor expectancy table. The IRS, Sam and I will both tell you, has an awful lot of tables you can look at. But you take the age of the younger person along the top, under the age, and then you go with the older person along the left-hand margin, and where those two intersect, that's the divisor you will use for your RMD. And I think we're going to go on here now and talk a little bit more about RMD aggregation. And in here, now here's the idea that, and we're going to just say you have 3 separate IRAs. And for the sake of making this simple, let's say that you have $100,000 in each of 3 different IRAs that are shown at the bottom of the screen or the slide here. In the first one, you have growth stocks. Okay, this might be Netflix and Apple and Google and so on. And number 2, you have dividend stocks. It might be AT&T and IBM. Some are the older companies. They have the steady dividends but lower long-term appreciation than the growth stocks. And in the third one, you have master limited partnerships, some closed-end funds, maybe some more alternative type investments, higher dividend but potentially volatile. Well, why are we bringing this up? Well, so if you have $300,000 combined, $100,000 in each of these IRAs, and I'm going to use the 4% as just a ballpark number, you're going to have to take $12,000 out of your IRA, pay taxes on it, and you have then satisfied your RMD for that year. But you might not want to take it out of IRA number 1. Well, the IRS will allow you to aggregate your IRAs together, and they just want $12,000 taken out. You can take $4,000 out of each, you can take $6,000 out of 2 of them, or you can take $12,000 out of 1 of them. Makes no difference to the IRS, but this is only using IRAs, and we'll talk about some exceptions in the next few slides.
Yeah, so a lot of times when we talk about account aggregation, and this is kind of a general rule of thumb, so if you're taking notes, this is one of the tips to maybe write down. What we have found is that in order to position yourself just with respect to retirement as a whole, you want to try to make sure that you can maintain maximum flexibility. If you think about it, what you're really trying to avoid is adverse market timing. You don't ever want to have to liquidate an asset at a time when it's at a lower value and end up having to sell more of the asset. So as we go through this, we're just going to go ahead and tell you we're not expecting any of you to perfectly master the rules of aggregation. We just want to spend a minute here and introduce the concept so that you understand what it is when you hear it later. So Tad spent a little bit of time talking about how you can aggregate IRAs together that you own. Now let's spend a minute talking about some areas where you can't aggregate accounts together. So the first one is What about income from annuities? Can you use the cash flow from annuities to basically cover your RMD? And in a word, no. Let's use a classic example, and let's say that somebody has $1 million in an IRA, and they're sitting down and they're doing some income planning, and what they're thinking is, when I look at all my other income sources, Social Security, maybe a pension, whatever else it is, and I look at my income gap, it's about $35,000 a year. And maybe their advisor, sees this and they say, well, hey, you got $1 million here. If you annuitize half of it, where rates are right now, they'd pay you out $35,000 a year, and that'll cover your gap. And they're thinking about required minimum distributions, and they're saying, okay, well, if it starts at 3.6%, then that'll actually cover my RMD as well, and the other $500,000 I can just let grow. But unfortunately, you can't do that. Whenever you annuitize part of a retirement account over a period of 10 years or more, the cash flow from the annuitized portion does not count towards the RMD for the non-annuitized portion. So in this instance, the individual would still have to take an RMD from the other $500,000, which is about another $18,000 in taxable income that they weren't planning on taking. We're not trying to say it's good, bad, or indifferent, but just to use an example, we see this happen a lot maybe when somebody has an account with BALIC or with TIA, CREF, or something like that, where the way that the account is structured, people end up annuitizing part of it and not annuitizing part of it. And this is where you have to be really mindful of the fact that there could be a firewall between those different components of the investment plan. Secondly, what about 401ks or any employer plan that you haven't rolled over yet? Well, the general rule of thumb is that you need to treat each employer plan as a separate plan. So if you had 5 different 401k plans, you need to take 5 separate RMDs. The only exception is 403b plans. So 403b plans you can aggregate with other 403b plans, but they would still be separate from your IRAs and your 401ks and 401as and whatever else it might be. In fact, this is one of the reasons why oftentimes, unless there's some proprietary product in the 401k plan, or if you're trying to leave it there to have protection from creditors or something like that, most often people often roll old employer plans into IRAs to try to help with some of the aggregation concepts that we're talking about now. So here's a quick rundown on aggregation rules. So number one, you can aggregate any IRA that is in your name, and it doesn't really matter what type of IRA it is. It could be a traditional, a rollover, simple SEP. If it's an IRA and it's in your name, you can treat it all as one account. However, you can't combine RMDs for spouses. So if you're married, you can't, for example, say, we're going to take the RMDs for both of us from my account this year and we'll do your account next year. Retirement plans by definition are individually owned, and you have to do your own RMDs. In addition to that, you can't aggregate RMDs from IRAs that you're the owner of from IRAs that you inherited, assuming that you didn't inherit it or take it from a spouse. So whenever somebody has money in a pre-tax account, we got to remember IRAs, 401ks, things like that were never really designed to be wealth transfer tools. It's a way for you to save for retirement and allow to have some compounding tax-deferred growth. But eventually that money needs to be taxed. So anytime you have a pre-tax account that's left to a non-spouse beneficiary, it turns into what's called an inherited or beneficiary IRA. And this is one of the areas where the Secure Act has actually made some recent changes. It used to be that when you inherited an IRA, you really had 2 choices you could choose from in terms of how you wanted to take the money out of it. The first choice was the 5-year rule. You could liquidate the account in a period of 5 years or less. The second rule is something called a stretch IRA. So think about this. If you had an IRA and let's say it had $1 million in it at the time of your passing, and let's say you left it to a non-spouse beneficiary, like a sibling or a nephew or a niece or a child or grandchild, they used to have the ability, even if they weren't of the age where they had to do RMDs, because it was an inherited IRA, they still had to continue with the process. But through a stretch IRA, they could reset the clock in a sense to their younger age. And because of that, they'd have to take out a smaller amount, and they have a greater likelihood of keeping the bulk of the account intact for the rest of their life and having more of the account grow tax deferred. So it was a good thing. However, with the Secure Act, they did change the date that you have to take your RMDs from 70 and a half to the year that you turn 72, but to kind of make up for it, they eliminated the stretch IRA. So now anyone who receives an inherited account from a non-spouse beneficiary, or if they leave it to a non-spouse beneficiary, they now have to fully liquidate the account in no more than 10 years. And you can imagine, by compressing the distribution period, that means that more amounts are going to have to come out faster, which is going to increase the taxation on it. In fact, I read an article not too long ago that they're estimating that by doing this, it may increase taxable receipts by over $15 billion. So this is something that a lot of people are proactively planning around now. Going back into the annuity part, you cannot aggregate the cash flow from a retirement account that's been annuitized over a period of 10 years or longer with the period that's not been annuitized. There's a firewall between those two accounts in a sense. And then lastly, distributions from employer plans have to be taken on a plan-by-plan basis. The only exception is 403B plans, where you can aggregate other 403Bs with other 403Bs, but it's still separate from your IRAs and separate from your other employer plans. So again, it's not that you need to perfectly master the aggregation rules, it's that you need to be familiar with what they are. In fact, one of the things that we do in the RMD risk report is try to identify any things that you may need to do strategically to be able to be in a better position with respect to aggregation. And if there's any potential problems, the report does a pretty good job of identifying those as well.
We should mention, by the way, that Roth IRAs do not have any RMD attached to them. A Roth IRA, you have already paid the taxes up front when you made the deposit into the Roth IRA, and they are never taxed again. So Roth IRAs are a separate issue. No RMDs required.
No RMDs required, that's right. So Tad, now let's jump into talking about taxation related to RMDs.
So taxation with RMDs, think about where this money is coming from. These are in accounts where you have been tax deferring for many years and you've never paid taxes on any of this money. So there are no special rules applied to them. As you take money out of IRAs, they are taxed as part of your regular income for that year. Remember that the reason you put money into it in the first place was because you figured by during your working years, your income tax level would be higher, and thus you would postpone paying taxes until your retirement years, when the theory is that your income tax would be at a lower rate. We'll see with current taxes and all the things that are going on with taxation if that actually is the case or not. We do want you to think, though, about the extra tax liability this is going to create. And I think the best way to kind of explain this concept is, let's just go in and say that you're making a married filing joint indenture between the two of you, you're making $120,000 per year. Okay, so we're going to go into this chart, go down to married joint filers, and we're going to see that the tax rate is 22%. Now, we like to point out it's not 22% on the whole $120,000. Everybody only pays 10% on the first $19,050. And everyone pays 12% between $19,000 and $77,000. But between $77,000 and up to $165,000 is 22%. When you take this RMD, and let's say you have that $12,000 RMD we were talking about, it's all going to be taxed in your top tax bracket. So in this case, you're going to be taxed 22% on that $12,000 RMD. So it kind of rides on top of all of the other income that you have that year. And as you're doing tax planning, you want to keep that in mind. Social Security, same way, when you're doing adding income sources, tax-free municipal bond interest, and your IRS benefits, what Social Security calls provisional income threshold, over $25,000 for singles or over $32,000 for married, portion of your Social Security benefits can be taxed. Do understand that this RMD is going to play in there as part of the all income sources. So it's going to, again, sit on top of the other income that you're getting that year.
Okay, so now that we've gone through a little bit of the basics on RMDs and how RMDs are taxed, let's move into the second topic, which has more to do with some of the most common mistakes that we typically see people make around managing the process of required minimum distributions. So to kind of frame this a little bit, There's something that we like to follow called the Employee Benefit Research Institute, and they developed the EBRI Retirement Security Projection Model. And in this model, they have a database of about 27 million 401k and IRA account holders. And in their one of their most recent revisions, I believe is maybe the 2019 revision, their model is currently estimating that a little bit more than 40% of all households in the United States are projected to run short of money during retirement. And we want to just let that sink in for a moment. Subjectively, and I think Tad would agree with this, when we talk to people about how they feel with respect to their preparedness to retirement, most people feel favorably about their ability to be able to handle it. But if you look at some of the data, and this is a classic example, it's actually projected that more people may run into issues in retirement than what they think. And one of the questions is, why is that? Why is the disconnect where people feel like they're in a good position, but unknowingly something might be going on that actually may be a problem in the future? And so that's what we want to start to look at. One of the central questions that you have to ask yourself as you prepare for income distribution, but also more specifically when you prepare for managing required minimum distributions, is have you adjusted your asset allocation to prepare for the income that you're getting ready to distribute? So a classic rule, and another tip, again, if you're writing this down, is that ideally you like to see the withdrawal that you're going to take come from the interest or dividends of your investments, so that you're not in a situation where you have to sell an asset or take it from principal. And we'll give you an example kind of why that is. And we can talk about maybe something called dollar cost averaging or reverse dollar cost averaging. So many of you watching this webinar may be familiar with dollar cost averaging. And if you're not familiar with it, we'll give you 30 seconds on it. Essentially, imagine somebody who is making regular contributions to a 401k plan. They have 5% of their paycheck biweekly go into a 401k plan, or even someone maybe who's self-employed that makes an annual contribution into a SEP IRA. Anytime you're making a contribution of a relatively similar dollar amount on some type of consistent interval, you're taking advantage of dollar cost averaging. What happens is when the market's at a relative high, your money buys fewer shares. And when the market's at a relative low, your money buys a whole lot more shares. And over time, the average purchase price comes down and it leaves more room for growth. So it's a really good thing on the way up. During the accumulation phase, we would call this an accelerator. But what you have to understand is that the same process happens, but in reverse on the way down. It's called reverse dollar cost averaging. So again, when the market is high, now you're going to have to sell fewer shares. But when the market's low, you're going to have to sell a lot more shares to get to the same dollar amount. And over time, that forces your average sale price down, and it causes you to sometimes cannibalize the principal in your account, even if the rate of return looks good. Think about a mortgage, for example. If we talk about a 15 or a 30-year mortgage, you and I both know that, in the early parts of the mortgage, let's say the first couple of years, you're predominantly paying interest and maybe a little bit to principal. But by the end of the mortgage term, your contributions are going almost all to principal and maybe none to interest. And over a 15 or 30-year period, you've paid off all the principal. Well, that's the same math that's involved when you're taking money from an investment pool. It may start out by taking a little bit from interest, a little bit from gains, and a little bit from principal. But the more you take from principal, the more you end up taking from principal, the further you go, and ultimately people run out of money. And we always say, you don't ever want to be in a position where you're bleeding through the principal that you've accumulated over all these years simply due to a federally mandated minimum that you need to take out of your account. So you have to make sure that you understand first that these things exist so that you can start thinking about how to navigate around them and be in better preparation for managing required minimum distributions.
So let's go now into how to integrate your RMD strategy into your overall retirement plan. We're introducing these concepts because what Sam's describing is so important. If you leave your portfolio the way that it always has been, you're going to spend your retirement trying your best to guess at when is the best time to sell stocks or funds so that you can pay your RMD for the year. And a lot of times people will wait till the end of the year to do their RMDs and figuring they can get the growth during the year. But how many years can you remember, and there have been several in the past decade, where the market really tanks at the end of the year? Now you're going to have to sell more shares or of funds or stocks to be able to pay your RMD. There is a better way to do it, and that's by using more of an income-based portfolio. So what this slide up here is emphasizing is that the total return inside a portfolio is made up of both income and growth. And most of us are really only focused on growth because that's all we've ever learned about. But let's say, for example, you can go to a bank and get a CD with a 10% interest rate. Now, we know that's not possible today. You'd be lucky if you even get 1%. But for the purpose of illustration, realize that the interest that is being paid on the CD is being paid to you in cash, and you can go use it for income. You still have the money in the CD at the bank, but they're just paying you interest, and it's very easy to spend that money. Now let's go to the second line here and say that you have a growth stock. And let's say that you bought 10 shares of Amazon earlier in the year and that it's gone up in value by $30,000. All right, so it's gone up 10%, but to be able to realize that 10% and use it for income, you have to sell some shares of Amazon to create that money for income. So that's all the G part of the equation. That's all in growth. If you have a mutual fund or an exchange traded fund that's invested in dividend paying or value stocks, you might get 3% in dividends and 7% in growth. That 10% might be split up this way. But again, that 3%, you can let that go into cash and not be reinvested, use that for income. But if it's in 7% that you're getting in growth, again, you'll have to sell the security to be able to realize that. So in retirement, income becomes the emphasis of what you want from your portfolio. And that's why you start to focus a lot more on what's giving me more income in the form of dividends and interest as opposed to growth. This is the page from a portfolio, and it's nice in our webinars. This is fairly easy to see the numbers on the page. It's not important who was managing this account for our client. What is important is that you start to understand how you can start looking at some of these statements. And if you look at the right-hand column, it says yield. Well, yield is actually dividend yield. That's what they're talking about in terms of for each of these securities. And these are all mutual funds, by the way. You can see how much they're paying out in yield. And next to that, the second column from the right, it shows the annual income you can expect from each of these funds. Okay, so let's look at the bottom right-hand corner of the page. The number 7,134 is the annual income you can expect from this portfolio. Now, if you go over to the column that says ending value, you can see that the portfolio has $405,731.03 in it. And you're getting $7,134 of annual income. Well, I'll do the math for you. That's something less than a 2% yield. And when you have your money invested, wouldn't you like to have something closer to a 4 or 5% yield if you're going to be looking to take income from a portfolio? Of course you would, but this is more growth oriented and less income oriented. And that's why we're stressing that as you get close to retirement, and certainly in retirement years, you do want to be paying a lot more attention to the income, the I part, as opposed to growth strategies. We also want to spend just a few minutes and explain to you how bonds work. Everybody knows how stocks work, and when you buy a share of stock that you become an owner of the company. But what about a bond? Did you realize that you actually are a lender? And any kind of bond that you're buying, you are lending your money to another entity. In the case of an individual corporate bond, we're showing you a Ford Motor Company bond that is currently available on the market. An individual corporate bond has $1,000 par value. What that means is that at some point in the future, it's going to be worth $1,000 given back to you. Generally, you can buy them for about the same price. But what Ford Motor Company is promising you here is that they're going to pay you 4.25% per year in interest. That's called a coupon when it's a bond. And that they're going to give you your $1,000 back that you bought the bond with at some point in the future. That point in the future is specified by the maturity date. And so you can give Ford $1,000 right now. They're going to pay you 4.25% interest each year That's the all I portion, remember, from the TR equals I plus G. So you can spend that money. And on August 20th, 2023, they're going to give you your money back. Okay, two things are guaranteed here. The coupon or interest rate is guaranteed, and the maturity date is guaranteed. The only way that Ford Motor Company can get out of paying you your $1,000 back on August 20th, 2023 is if they go out of business. And if you say, well, certainly in the next 3 years, Ford's not going to go out of business, then you feel pretty secure buying this bond, correct? Standard & Poor's and Moody's, back to the slide for a minute, are going to help you decide which individual corporate bonds are safe because they're going to give you a credit rating to work with. And using the Standard & Poor's column here, anything that's triple B rated or above, including the AA and AAA ratings, those are all investment grade bonds. Pretty safe, very, very low chance of these companies going out of business. Once you drop down below that triple B rating, again, the Standard & Poor's column, that's called a junk bond. I'm sure you've all heard that expression. It's a junk bond because it might not be worth much. And the lower you get, if you get down to the triple C's and double C and so on, the likelihood of you losing the $1,000 you lent is going to be much higher. So generally, when people are doing a bond portfolio, they're going to stay in the investment grade triple B ratings and above with the guarantees that are attached to them. The reason that a bond, an individual corporate bond, differs from a bond mutual fund, though, as were showing on that statement, and I think we're going to show it to you again on another slide. A bond mutual fund has no guarantee attached to it. So there's no guaranteed interest rate or coupon, and there's no maturity date. And a mutual fund is also going to charge you an expense ratio to manage the fund. So if you're working with an advisor who says, oh, you're retiring, tell you what, we'll put you in more bond mutual funds, you might want to talk to a different advisor because that's not what you want. That's not going to give you the guaranteed income that you're looking for and the safety offered by an individual bond. So which fund would you select here? And what we did from that statement is we took that top fund that was shown on that page with the 10 mutual funds, and we compared it to other mutual funds that are invested the same way. The client was totally unaware of this, but this fund, the Advantage Fund, the Dreyfus Fund, represented 13% of the holdings in that portfolio. The fees were 188% higher than other mutual funds that were basically invested in the same securities. And thus, it offered 153% lower performance. These are the types of things, particularly if you have a portfolio invested in a lot of mutual funds or exchange-traded funds, that you want to be paying attention to. Am I invested in the right fund at the best or lowest expense ratio that's being charged to me? The Department of Labor is getting involved in all of this, and over the past 10 years, there's been a lot of discussion about fiduciaries in the investment world, and a fiduciary is someone who must act in your best interest, and that many people feel that should be required. Well, here's why. Using that mutual fund that won the first one on that page of 10, this poor client was, from this particular brokerage house, was losing 48% of their potential appreciation because of the fees that they were paying. Now, was it anywhere on a piece of paper that told them that? Of course not. The fees are not emphasized on financial statements, but through education and looking in places like finance, Yahoo Finance and Morningstar, you can see the funds, the expense ratios you're paying inside funds that you own, and making sure this isn't happening to you as well.
Okay, so now we're rolling into the end of the webinar. We want to take all the content that we've been talking about and pull it together with the requirement of distributions and show you how the two go hand in hand. And I mentioned earlier in the presentation that we do this as two parts, and that really one of the things that we're going to talk a little about later is the RMD risk report, which again, there's a lot of ways to do it, but it's probably the best tool that we've had so far to be able to help our clients understand kind of how they're structured related to RMD risks and things that they need to think about. And so I want to walk you through a couple of areas where there's some mistakes, and I want to walk you through a case study. And as I do this, I want you to think about your own situation and see what pieces of information maybe are applicable to you. And again, when we run the RMD risk report for you, hopefully it'll make more sense when you try to tie the two together. So real briefly, there is a number of risks you have to pay attention to when it comes to retirement distribution. Everything from market risk, credit risk, reinvestment risk, interest rate risk, political risk. In fact, there was a really good report written about retirement risks that categorized retirement risks into two basic categories. You had personalized idiosyncratic risks, and you also had macroeconomic societal risks as well. So right here, we just have four basic ones listed: longevity, timing, withdrawal rate, and market risk. These are some of the most prevalent risks that we see people run into when it comes to RMD management and really income management as a whole. So let's show this to you in a little bit of a case study and walk you through this. And as I do, this was actually an individual that we ended up consulting with years ago, back in 2016, I think it was, when he was getting ready to retire. In fact, he went through a process very similar with the RMD risk report that we're kind of talking about here. So the individual was 70. And I remember back in 2016, he was bumping right up against when RMDs would start, because it would have been the year that he turned 70 and a half. And he was a retired physician. In fact, he had just retired that year. So he needed to make his required minimum distribution. He had Social Security, and he was trying to figure out some cash flow decisions as he entered retirement. So we evaluated two different options. In his current situation, we looked at what it might look like if he was in a position where he had to manage trying to sell some of the shares in his investments, which is also referred to as a liquidation strategy. And then we looked at another scenario for comparison that focused more on him trying to balance the right amount of income and the right amount of growth based off of his fact pattern. And we were able to compare the two. So this was just a quick breakdown of where he was. So he had an account with Voya 401k. He had an IRA, some variable annuities, and some non-qualified investment accounts, and you can see some partial income. Now, for any of you that were rigidly taking notes when we talked about account aggregation, warning bell should be going off first, telling you that he's in a position where he's not going to be able to aggregate these accounts. And so as we go through this, let's see what other issues occur. So when we looked at his RMD calculations, we calculated what it would be in 2016 and what it would be in 2017, because we wanted to know if there was a benefit or a disadvantage from a tax standpoint of doing it in 2016 or having to do two in 2017. When we looked at this, though, we first realized that the tax impact for him taking the requirement of distributions by running it through a tax calculator suggested that he was going to have to pay additional income taxes of $17,316 due to the RMDs. Now, when we looked at the total taxes paid in 2016 and 2017, by doing the RMD in 2016 or doing two in 2017, we actually found that it was about a break even. And so we were able to tell him, you know, it doesn't really matter whether you do it. We can look at it for reasons beyond just taxes now. So what we're showing you here is the actual market return from the year 2000 through 2015. And again, we did this in 2016. That's why it kind of stops here. And I know you probably can't see the numbers here at the bottom, but we looked at the returns from the market. We looked at the fees that he was paying based off of his structure. We looked at how many shares he was going to have to liquidate based off of how he was set up. And the black numbers at the top are showing you how many shares he would have had to sell in those years to be able to make the RMD. In strategy number two, we then compared it, all other things being equal, to what it would look like if he balanced it for the right amount of income and the right amount of growth. So what we found is that if all he was trying to do was manage RMDs, then he would have started maybe with about 1.64 million in collective retirement accounts. And 15 years later, he may have actually gone through about 600,000 in principal, simply trying to satisfy the RMD. Now, in option two, if we balanced it and were able to adjust the income and growth in the portfolio so that it aligned with the RMD he was going to take, he could have started at 1.6, satisfied all the annual RMDs for 15 years, and still been at approximately 1.6. So then we took the same scenario, but we stress tested it. We said, what if he wasn't just managing RMDs, but what if he was trying to live off of this money? And so we applied a 5% cash flow over that same historical period in the market, 2000 to 2015. Well, in his case, he might have started at 1.64 million, but 15 years later, he may have gone through 2/3 of the portfolio and been down to about 376,000. Now, if he had tried to adjust his portfolio for the right amount of income and growth, it doesn't mean that he would have perfectly preserved every dollar he started retirement with. But it means after distributing 5% per year after 15 years, he may have started at about 1.64 and still been at about 1.6. And here's the point. There are some things in retirement that you just can't simply know at the start of retirement. Think about things like the impact of inflation, changes in taxes, changes in your own personal health, other emergencies that come up, family emergencies outside of your core family. Just trying to be flexible and agile. Well, the question we have to ask ourselves is, who would have been in a better position to manage the unseen things that may happen throughout the course of retirement? The individual who started at 1.4 and because of a poor distribution strategy ended up going through 2/3 of their portfolio? Or the individual who after 15 years still predominantly was able to retain most of the principal they started with? And that's why, you can take the numbers, and the numbers are important, but at the end of the day, it's about how it practically impacts your life. That's why understanding these pieces are so important, and why, understanding requirement of distributions and how the impacts may impact you becomes a really important part as well. So earlier in the presentation, we talked about how we always do the public education series in a two-part process. This webinar that we did here is really intended as a group lecture. We used to do them at DePaul, Northwestern, Loyola, wherever it was. And the intention was to make you familiar with certain concepts. But at the end of the day, what really matters is how you practically apply these concepts to your lives. And that's why we started doing the second part, where we will run the RMD risk report for you. So that you can crystallize these pieces and know what applies to you and what doesn't. So on the right side of your screen, you should see something here that talks about the RMD risk report. And it should have just probably popped up here. If not, it'll probably pop up in the next 30 seconds. But the whole idea is we're willing to take some time to run the RMD risk report. We already have it built. We do it for our clients every day. All we need you to do is click the button on the right where it says pick my date and time, and pick your delivery date so that we have some time on the calendar that we can set aside to deliver your RMD risk report to you. It doesn't make sense to go through this process and just assume that everything's going to be okay. Tad and I can both tell you from experience that sometimes when you sit down and you look at the data, you find that really you are in a great position. You've done everything you need to do. You're generating enough income, and you've mitigated all the risks that you really need to. But other times you have people that are so far out of alignment that they need some major work or a major overhaul. But the reality is most of you are probably somewhere in the middle. It's not that you're in great shape, and it's not that you've completely missed the boat. It's that you're looking for that one or two little pieces of information, that one little nugget that can just move you forward a little bit further and a little bit further, or potentially help you avoid depleting principal or incurring a 50% penalty. And for attending the public education series, there's no charge for this, but we're willing to run the RMD risk report for you to be able to help crystallize this information. Now, time is limited because we do have clients that we have to work with. So what we do ask is that you go ahead and you click the button at the right where it says pick my date and time, and try to pick a date. Now, if none of the dates that are available work for your schedule, I believe there's something that you can click that'll allow you to say that, yes, you do want to schedule a delivery meeting, but you need to kind of connect with Eric, who runs the public education series, and he'll try to help work something out for you. And this part's important also. When we do the delivery meeting, understand that what we're trying to do is give you real information and help you understand the impacts of RMDs. Right. But try to be prepared as well. I know I don't normally need to say this. People usually have all the information readily available. But if we're asking you about accounts, and if we're asking you whether it's pre-tax or post-tax or Roth or taxable, you need to have some general idea of kind of how things are situated. This really is for your benefit because it's the things that you don't know that could really end up hurting you. So we're going to leave this offer up for a couple of minutes here so that everybody can pick their date and their time. When you click the blue button, it will open up a separate web page. So it's going to take you into a new web page that's through our main website, company website. And on that, on the right side, you'll see where you can put in your information and select your date for your delivery meeting so that you can get a copy of your RMD risk report. So that's all we have. Tad, any final thoughts for everybody?
No, just that I hope that you realize we've presented a lot of material this evening, and as we do in all of our webinars and seminars, and it probably is a little bit confusing. That's the primary reason why we have the follow-up, so that we can answer things that are more about your personal situation. We were never, all of us, educated very much about these financial matters when we were in school or at any other time. And baby boomers, the generation that is currently retiring, do not have the pensions for the most part that their parents' generation had, nor can they go to a bank and get a 5% CD, which you could do back in the 80s and 90s. You're lucky if you even get 1% now. Planning a retirement nowadays it's very complex, and we'll tell you, though, if you will take advantage of learning more about it and paying some attention to this, you're going to have a lot more enjoyable retirement because you won't be worried about your money. But you do have to do some educating and learn about this stuff, and that's what we're offering. So we hope you'll take advantage of it.
Yeah, absolutely. So that's all from us. We're going to leave this up for another minute or so that everybody can click the blue button, go to the website, pick the date for their delivery meeting, and then Eric will be in contact with you following the webinar to let you know that you're either confirmed, or if he needs to juggle some stuff around, he'll help make all of that work. So hope everybody enjoyed the webinar, and we look forward to talking to you soon.
Thanks, everyone. Take care.